Bob Lambert's AssetProtectionTraining.com presents Ryan Fowler on the Non-Qualified Personal Residence Trust.
Hi, my name is Ryan Fowler, and welcome to the AssetProtectionTraining.com video series. This is part 2 of a 4-part series on how to protect your home. And in part 2, we're going to talk about a really great tool called the Non-Qualified Personal Residence Trust. So let's go ahead and get started. First of all, before we talk about the NQPRT or the NQPRT, Non-Qualified Personal Residence Trust, I want to go over the basics of what any trust has to have to protect your assets, because this is a source of a lot of confusion. There's a lot of stuff on the internet saying, oh, this trust is great, where it really doesn't protect the asset at all. So first of all, if you want a trust to protect your asset, it has to be irrevocable. That means that the grantor being, they're also called a settler or truster. That's the person that initially gifts money into the trust, or anyone that later gifts money into the trust. They cannot have the right to terminate or revoke or amend the trust. They have to give up that control. We may be able to make the trust terminate under other provisions, but the grantor can't do that. Second, the trust must not be self-settled. And a self-settled trust, pretty much every state has laws against self-settled trust. A self-settled trust is a trust where you gift assets into the trust. You're a grantor or settler. You settle the trust. But you continue to benefit from those assets in some form. You use them, or you enjoy them, or you continue to get payments of income from the trust because you put income-producing assets into the trust. You can't do that. Now, there are a few states, there's actually I think 10 or 11 now, that allow what are called a domestic asset protection trust. And that's a trust that can be self-settled, still has to be irrevocable, but it can protect your assets. We're going to talk about the DAPT and why it's not as good as a non-qualified personal residence trust. We'll talk about that at the end of this series. Finally, penultimately, beneficiaries or grantors should not be a trustee. When you set up a trust, you have the grantor, also known as truster or settler, and they gift money or other assets into the trust. The trustee is a fiduciary who takes title to those assets and then manages them for benefit of the beneficiaries. And again, if the grantor and beneficiary is one and the same, that's a self-settled trust. So the beneficiary and grantor, neither of them should be trustees. If you're a beneficiary and a trustee and someone sues a beneficiary, then the general rule is a creditor can step in the debtor's shoes and do whatever the debtor is able to do. So if you're a beneficiary, but you also have control over the trust as trustee, and you have the discretion to put assets out of the trust or not, or give them, wherever, well, the creditor of that beneficiary is going to be able to have those same powers, and he can use that to his advantage and clean out the trust. Or if the grantor is also a trustee, then a creditor of the grantor can do whatever the grantor can do as far as the grantor's powers as trustee over the trust. So that's a big no-no. If grantor or beneficiary, don't be a trustee unless maybe you're a grantor and you only put $5,000 in the trust, but you're also a trustee. Well, that $5,000 may be exposed to your creditor. The rest of the trust assets won't be, but just keep that in mind. Finally, the trust needs to have what are called spendthrift clauses and other anti-creditor language in the trust. A spendthrift clause basically it's supported by the laws pretty much of all 50 states, either case law or usually statute law in most states now. But it's basically a clause that says a beneficiary's interest in the trust while the assets remain in the trust are not attached by creditors. And there's other anti-creditor language too. If you want to read more about this anti-creditor language, I've written a book. It's called Asset Protection in Financially Unsafe Times, and co-authored with Dr. Arnold Goldstein, and chapter 12 or 13 talks about asset protection features of trust. Chapter 12, actually. Okay, so moving on. So what is a non-qualified personal residence trust? Well, it's an irrevocable, non-self-settled trust. It protects your home, but it can also be used for protecting rental property. Or any other income-producing property, or you can actually use it for any type of asset as long as it produces a reliable, steady stream of income. The non-QPRT or NQPRT, it also removes the value of that property from your taxable estate. So one thing that a lot of people are talking about is the estate tax, unless there's some new legislation passed, which probably won't be, but the estate tax coming back January 1st, 2011, a tax rate of 55% on any assets in your estate over $1 million at the time of your death. That includes a life insurance payout. So a lot of my clients have $1 million life insurance policy or $500,000. $1 million payout right there on your death will put your estate into the taxable region. So if you have $1 million home and a $2 million estate, your first $1 million isn't taxed, but the value of your home, that second $1 million, could be taxed. Well, the non-QPRT removes that entire value of that home out of your taxable estate. No longer, that $1 million no longer subject to estate taxes, and at a 55% tax rate on an estate that large or larger, you just saved yourself $550,000 that'll go to your heirs instead of going to Uncle Sam when you die. So in that example here, that's not a bad way to go. And you get asset protection too. So what a bargain. That's something that no domestic asset protection trust will do, which we'll talk about shortly. So a few other features of the NQPRT. The original homeowner is the owner of the NQPRT for income tax purposes. That means any activity of this non-qualified personal residence trust is treated as if that activity was done by the homeowner or the prior homeowner, the person that owned the home prior to its transfer to the trust. So when you set up this NQPRT, you actually sell your home to the trust. What that means, you don't trigger any capital gain when you sell your home. And also, if the trust later sells a home that you're living in, you get to keep the Internal Revenue Code Section 121 exemption. That is for a single person, $250,000 exemption on capital gain, or for a married couple, $500,000 exemption on capital gain, where even if your home's appreciated and you sell it for a profit, that amount is exempt from taxation. You get to keep that with this type of trust. And there's a lot of special language drafted into the trust specifically so that the beneficiaries of the trust, which is the prior homeowner, will keep these tax benefits. So, and again, it works for rental properties as well. So how do we implement a non-QPRT? It's not just the drafting of the trust, but how we fund the trust and get the home into the trust is also very critical as well. And if this isn't done properly, you may not get the asset protection estate tax savings. Thank goodness you came to an expert that knows what he's doing. So, first off, you need to have someone besides the homeowners fund the trust, because whoever gives assets into the trust is the grantor, and the homeowner is going to be a beneficiary of this trust. You cannot have the homeowner be a grantor and beneficiary. So usually the homeowner will make a gift, or you have a relative that already has money they want to give to you, and they're going to put it in the trust. And ideally that's going to be about 10% of the value of the fair market value of the property that you're transferring to the trust. So if the homes are $500,000, then you're going to need someone other than the homeowner to give $50,000 in the trust. It's not hard to do as long as you have that amount of liquidity. And most of my clients, if they have a $500,000 home, they're going to have $50,000 in some type of trading account or savings or something like that. You actually get that money back, and I'll talk about that in a moment. But you need to gift that to a trusted friend or multiple trusted friends to avoid gift tax consequences if the initial amount's too high. And then they're going to put that into the trust. That makes them the grantor of the trust. And then you sell the home to the trust. It's going to take the form of a privately financed installment sale. So the non-QPRT gets the home. They're going to pay the money they receive for initial funding. They're going to pay to the homeowner as in a down payment, because it's just like a normal privately financed sale. It's going to have all the trappings of a normal sale. Pay the down payment to the homeowner, and then the trust is going to pay for that purchase over time with an installment note. And that can be a self-canceling note if desired, and I'll talk about that in a second. What happens is when you sell the home to the trust, that home is no longer in your taxable estate if you've done things and the trust is set up properly and all of that. you do get a installment note back, and over time that installment note is paid down because the trust is paying off the note, its obligation to you, until everything's paid in full. So under normal circumstances, after the note's paid off, there's nothing left in your taxable estate as far as residual, no value, the note has no value, it's been paid off, the home's not in your taxable estate, and so you just realize that the great estate tax savings. However, what happens if you die before the note's paid off? Well, if it's a note for $500,000, only half has been paid off. And then you die, there's still a note worth $250,000 in your taxable estate, unless you do what's called a self-canceling installment note. And that's a special type of note. This is held up when challenged by the IRS on multiple occasions. It's a special type of note where if the seller who has a note and receives the money from the trust periodically, if they die, then the note cancels, and the trust will just keep the home free and clear and won't have to pay anything more on the note. But what does that do? Well, that automatically gives the upon the seller's death, it gives the note no more value. So there's nothing in the taxable estate as far as the note's value. The note's gone, and so you basically, if you do, we call them skins, self-canceling installment note, SCIN. If you do that, then you're basically, you have to follow certain procedure, but if we're able to do that, then you guarantee that that entire home value is no longer in your taxable estate. We can also make it cancel in light of creditor challenge, but a lot of times we'll take this promissory note, we'll put it in an LLC or limited partnership, something like that, so if you get sued, the note's not in your possession and vulnerable to creditors. But it is an unsecured note, and there's anti-creditor language in the note too as an extra precaution. So moving on, the settler, what's going to happen is the settler, and we do this because of court cases that have come out, the settler, in order to not be in order to have protection and not be considered I've made a fraudulent transfer, he needs to pay rent while he lives in the home. But remember, the trust is paying off the home over the time, so the trust is making payments to the person that sold the home. And the person that sold the home, if they continue to reside in that home, which is usually what happens, they pay rent to the trust. And so these payments actually offset each other, and they usually end up zeroing out, although we can draft it one way or another for different reasons. Maybe you want extra money to accumulate in the trust, or something like that, to move more outside your taxable estate. Within reason, we can do that. The trust, so as you see, the rent payments, trust payments, they offset. Once the non-QPR is set up, the setup is kind of complex, but once it's set up, very easy to maintain. For a home that you live in, the trust is making payments to you, you're making payments to the trust. Because you are treated as the owner of that trust for income tax purposes, it's like moving money out of your right pocket and putting it in your left pocket. No taxable event in that situation, no tax return needs to be filed. We can just have it so once a year you cut a check to the trust, and once a year a trust cuts a check to you, and that's all you do to maintain the trust, and then the trust can pay property taxes, homeowners insurance, and then or you can keep that in your name. And then you're good to go. So once it's set up, very, very easy to maintain, tremendous benefits. So why not just a domestic asset protection trust? Especially if you live, like I said, there's, I believe, 11 states now. They allow you to just set up a trust, put the asset in the trust as the grantor, and continue to use that asset, and you have asset protection. That's what these laws in these 11 states allow you to do. So people would ask me, well, isn't that just simpler? Then I don't have to do anything. Well, there may be once in a blue moon where that's actually a good idea. But there are some serious deficiencies to DAPTs. Number one, let's say you live in a state such as California that doesn't have domestic asset protection trust legislation. They don't recognize that type of protection in California. So a person goes to a state that does have DAPT legislation, such as Nevada, and they get a trust there and then put the California home in it. Well, due to what's called choice of law issues, conflict of law issues, probably not going to work because you're going to be sued in California where the home is, where you are, and California court will probably not recognize the protections afforded in this other state. And my book, beginning on page 102, actually goes over at least 3 or 4 different court cases where that's what the court said, and case law is imperative that you pay attention to it, because if not, then your asset protection plan is at peril. So also, a DAPT is a self-settled trust, and if you put an asset into a self-settled trust, bankruptcy law says it has to be there in at least 10 years for it to survive bankruptcy, for the asset in that trust to survive Chapter 7. So non-QPRT, you don't have that problem. You don't have to wait 10 years and then declare bankruptcy under this bankruptcy statute. Okay, so DAPTs, no estate tax savings, generally speaking. You have to wait at least 2 years, and in many states up to 4 years, before you get any asset protection by law. So you transfer the asset into the trust. It won't protect your assets until 2 to 4 years after the transfer. Depends on state law. The state law will set whether it's 2 years or 3 or 4. Most states will require you to use a professional trust company in that state to kind of boost the economy, but my experience is you're looking at a minimum of $1,500 a year in trustee fees. You don't have to use a professional trustee. You can use a trusted friend, and they can work for free for the non-QPRT. And even if they charge you, probably just be $200-300 a year, because they're not going to be doing a whole lot as a trustee unless it's a rental property and they're acting as property manager. But for home, not so much. So for those reasons, I only use a DAPT, Domestic Asset Protection Trust. Number one, if you live in a state that has pro-DAPT legislation, and number two, maybe your state's really small and you don't need estate tax savings. Maybe you don't want to go through the initial hassle of a non-QPRT with giving money to friends so that they can fund the trust, or they just put it in themselves. And also of equity stripping, which we talk about in Part 3. This is Part 2, so next section. If equity stripping doesn't work either, then we'll consider a DAPT, but really I don't set them up very often at all. And so that is the end of this video series. We'll see you in the next video.